welcome everyone to our 2022 annual Business and Law speaker. I'm Chris Nicholls. I'm a professor here at the law school where I hold the W. Jeff Beatty Chair in Corporate Law and direct the Torys LLP Corporate and Securities Law Forum. And I'm very pleased to welcome you all here today for our annual Western Law Business and Law event. Now, as we'll explain in a moment, this year's event we've decided to do in a more of a conversation format than in a formal lecture, and we hope you find that interesting and engaging. But before I introduce our very distinguished guest, I'd like to call on the Dean of Western Law, Erica Chamberlain, to say a few words. Erica.
Thank you, Professor Nicholls, and happy Western Day, everyone. For those who don't know, today is the day that we celebrate the anniversary of Western's founding 144 years ago. And so I'm delighted to have so many of you joining us for Western Law's annual Business and Law lecture, whether you are here at Western or somewhere else in Ontario or in Canada. As we begin, I'd like to acknowledge that Western University, where I am situated, is built on the traditional territories of the Anishinaabe, Haudenosaunee, Lenape, and Chinookan peoples on lands connected with the London Township and Sombra Treaties of 1796 and the Dish with One Spoon Covenant Wampum. This land continues to be home to diverse Indigenous peoples whom we recognize as contemporary stewards of the land and vital contributors to our society. I know that others of you are joining this webinar from other places, and I hope that you will take the time to learn about and honor the peoples on whose traditional lands you are living and studying today. We're very fortunate to offer this Business and Law lecture series for you today. Thanks to support from Torys LLP and the leadership of Professor Nicholls, Western Law has been able to offer a Business and Law speaker series that is second to none, providing our students with direct access to the leading scholars, practitioners, and policymakers in the world. Indeed, Western Law has hosted many distinguished speakers as part of this series over the years, including several Nobel Prize winners, the Chief Justice of the Delaware Supreme Court, the former US Secretary of the Treasury, and literally dozens of the world's leading English language scholars in the area of law and business. We are delighted to continue that tradition today, and we thank you very much for attending. I'll pass things back to Professor Nicholls now to introduce our distinguished guest.
Thank you very much, Dean Chamberlain. And it is now my very great pleasure to introduce this year's Business and Law speaker, Dr. Bengt Holmstrom. Bengt Holmstrom is a graduate of the University of Helsinki and of Stanford University. He's held academic positions in Finland and at Northwestern University in the Managerial Economics and Decision Sciences Meds Department, at Yale University and at MIT. He has been the recipient of numerous honors throughout his distinguished career, including the Sveriges Riksbank Prize in Economic Sciences in memory of Alfred Nobel. That is the prize that is more commonly referred to as the Nobel Prize in Economics. Now, I've referred Dr. Holmstrom to your academic credentials. I'll call you Bengt if I may. But I know you've also has a very important and interesting background experience in business, and I know that's not so usual for academics. And I believe you've talked about this in the past, that that's really had a significant influence on your theoretical views, especially your views of corporate governance. So I wonder if you could just take a few minutes to speak a little bit about those aspects of your background, at least in general terms. And I think as we go along, we may want to have some draw a little bit more on some of those experiences and how they've influenced your thinking.
Well, first of all, thank you for inviting me, and happy Western Day. I did not know about it, but I've been to Western, and I actually spent a week in my early days there, so I know the place very well. Yes, I would say that I had no plans to become an economist. I had no plans to become an academic. I was a graduate student in mathematics and statistics and physics at the Helsinki University, and then right after that I went, operations research was my thesis, so I went I went to a company working as what I today would be called corporate analyst or corporate planning person. Not knowing anything about business, by the way, but the idea was that I would continue work on what was a corporate planning model, a massively big linear planning model, based on linear programming, and that took 2 years. The one thing that it was very influential because I learned a lot. If you have to build a model, linear programming model for a corporation, this was a huge conglomerate, one of the 10 biggest companies in Finland, and had 30 factories and so on. I went around the factories. I learned about what people thought, and I realized pretty quickly that so calculating something wasn't the problem. This is very much in the Hayek spirit. The problem was to get the information from these people that was needed for a meaningful model. And I pretty quickly concluded that the problem was an incentive problem. And that's where my interest in incentives started. And I was working with a CFO. So this was an incredibly influential time in terms of I still draw inspirations from it. And I have done it throughout my career. So yes, 2 years, very, very important.
And as you say, not always a background that people have, and I know you've also had, and we'll talk about Olivia some firsthand board experience at some pretty large organizations. So your work has dealt in particular with a number of areas, contracts in particular, contracts on the labor side, contracts both within and outside the firm. And those of us who teach corporate law and corporate governance often start off by saying to students, well, there are two basic ways of organizing activity. You can organize them through contracts in the market, or you can organize them kind of away from the market within the firm. And of course, there are contracts within the firm. And your work is really a lot about those two universes. So I want to just sort of drill down a little bit and frame the first part of our discussion, which is really going to be, I hope, about corporate governance. And I want to just remind everyone, it's now been just over 50 years, a little over 50 years since Milton Friedman published his provocative essay for the New York Times Magazine, "The Social Responsibility of Business is to Increase Its Profits." That article, at least as it is often been interpreted, has been subject to a lot of criticism. It always has been, but particularly recently, a lot of criticism. Someone said at a conference I can't remember who it was, he said, you almost have to disavow that article as a sort of a way to get into polite society now. You can't. And in particular, we've seen some developments in the last 15 years, I guess. Developments with the rise of ESG. ESG was a term that didn't even exist until 2004. Now it's everywhere, and there are whole bodies that are trying to figure out how to measure it. We saw the business roundtables, this exclusive club of some of the largest 181 or so of the largest companies' CEOs that issued its new statement of the purpose of the corporation in 2019, essentially reversing a similar statement of purpose that was made in 1997. The old statement said purpose of the corporation is to maximize shareholder value. In 2019, they changed that to say, I'm just reading a little bit from it, that the members, the 181 members of the Business Roundtable, affirm they share a fundamental commitment to all of our stakeholders, and they specifically refer to customers, employees, the suppliers, and communities, as well as the general goal of generating long-term value for stakeholders. So is the Friedman notion that the corporation exists to maximize, is it just old baggage? Is it out of date? Should we throw it out, or is there still something left in the Friedman model that is worth preserving, or have people been misunderstanding what Friedman even meant?
Well, that's a big question that has a very simple answer, which is in my mind, and that is that Friedman is alive and well, but Friedman's thesis, his language is a little unfortunate. That is, I'm thinking more about Coase or something like that. Friedman certainly understood that you have to take care of stakeholders. This juxtaposition of stakeholders versus shareholders is misguided in my view. That doesn't mean that the Business Roundtable couldn't make this announcement because it's telling something about the shift in the sort of stakeholder views. But my point is that as we'll talk a little more probably, maximizing shareholder wealth, or whatever we want to call it, profit was Friedman's language, but that's a little narrow. That itself takes care of the other stakeholders. That's the idea. That's basically what he was arguing, or at least we have interpreted it subsequently as him arguing, and I believe that's true. I mean, no company disregards workers. No company disregards climate change today, for instance. I mean, even whatever the board would have said, Business Roundtable would have said, they would take care of it. So what the sort of objective, if you want to be, is all the time, in some sense, the value of the firm is my view. That's the right objective. But how you go about maximizing the value or serving this value, it's of course a very difficult task. Then that shifts. Sometimes you will need to make put more emphasis on workers. Sometimes on ESG is today the emphasis, but workers were in the 70s, and all sorts of things come into play. Now we have these political issues. Climate change is really on the table. So that doesn't mean the objective function changes, is one way to put it. It's just how to achieve that objective changes. And that's, in my view, what the Business Roundtable is signaling. I mean, I think, and we'll talk more about it, I think the Friedman thesis is playing itself out massively right now, is my view. All board firms are trying to, be sensitive to ESG, and no self-respecting firm will say anything. Perhaps they are too sensitive to the ESG, but saying that they are not sensitive to ESG is a mistake.
There's been a lot of cynicism about the Business Roundtable statement, as you know, sometimes more than cynicism. There was a couple of academics who looked at the signatories and they said, well, if you actually look at their record, they actually not only don't lead the industry, they maybe in fact trail the industry. I think it was Lucian Bebchuk made the point that none of the signatories to the Business Roundtable's statement had anything from their directors. In other words, it was just the CEOs. And so if this was meant to signal a shift of corporate policy or strategy, they would have to have had board approval, and they didn't. So this doesn't seem to be, I guess the implication is this is more marketing than something substantive. Do you think that that's the case? I think your view may be a bit different, that really something is going on, and it's firms responding to social expectations.
Yeah, I think the key is that, I mean, I have been involved a little bit in these conversations. That is, not consulted, but joined, these meetings with boards and institutional investors. Not much, I shouldn't overplay this, but I have had that. I have, of course, myself been on boards for 30 years, so I have seen the board side, and I had a conversation with the IESE, from Madrid, or ESGI had a meeting last year actually, and Paulson was, commenting on what I said, but really it was actually more a conversation. And Paulson is a very prominent person, and is pushing, for ESG issues. And he said his argument was companies should do it because it's a win-win. I mean, could you say it more simply that he was saying what Friedman was saying? You know, they will do, in my experience, they will do things sometimes too slowly, and maybe that was what Paul Paulson really is concerned about. But they will do anything that is win-win. I mean, how could they not? Win-win meaning, you know, it's good for the company, it's good for, you know, the ESG or whatever objective you have. They will do that. That's why they are talking. Every statement today is, you know, every annual report has in it for sure ESG. They have to report on ESG and so on. They do it, you know. The thing that I have not heard the institutional investors say, institutional investors are nervous about companies not attending enough to the ESG. But the thing that they don't say is that, or are willing to say, we are going to give up $1 billion in order to save the planet. You don't get them to do that, is my view. And nobody that I've heard of, and this, as I said, this includes a handful of institutional investors, so this is not that representative. And neither does Paul Paulson say that that's what they should do. That's not what he said during the conference where, or in the panel that we were together. But he doesn't, somehow he sees what he says as being in conflict with Friedman. I don't understand it. I mean, Friedman is all about, the whole thing about Friedman is win-win. That, you know, you give the torch to the board and the CEO, and in order to coordinate all these different opinions. I mean, there's a lot of people that are, you know, investing in the company, and not all share the same view necessarily, even on the question of you know, what way to give to just money, cash, and other things. But you know, they will, you need some leader to integrate. I see it sort of as a, you know, a very visible hand, so to speak. You know, their task is to represent the workers, the shareholders, all of those. I mean, and by maximizing the value, it happens. This is Coasian economics. You know, Coasian economics says that, you know, maximize the pie and then split it according to, you know, the exit options that people have, the alternatives that people have. So it works. The Coasian story works well because if you are a worker, Chris, and I'm a CEO, let me put in, we should do it in reverse, but I started this way, so I do it this way. Then I will surely want to know what you value, because if you value something that is cheap for me to do, or suitably expensive, less expensive than what I then can extract from you, so to speak, back in terms of lower salary or harder work or more enthusiasm and so on. Usually it's something not material, but something, you know, like that. And I will do it, of course. I mean, I would be stupid as a CEO not to do something that you really value and makes you work harder and be more committed. And, you know, that includes the whole stuff about purpose. Purpose is nothing new for companies. I've been since the 80s on boards. So, you know, every company had a purpose. It's just that the language has changed, and now it's a big deal, as if it's some new idea. But you know, I've been on family firms, and I've been on Nokia's board for 13 years, and it's all. I mean, companies that don't see this, they don't survive. And so that's what Friedman is in my view. And I might add, it's really crucial that the CEO is maximizing value, shareholder value or wealth. You know, it's really crucial. And because otherwise, as we saw in the 70s to some extent, I think, they do sort of things that really benefit only them. You know, that was the old concern about corporate governance until this ESG came around. I mean, the whole thing with Michael Jensen and so on was about, you know, the CEO and the board not being sort of weak against the CEOs. But now this has changed. I mean, the whole corporate governance, by the way, it's a pendulum. It goes from stakeholder value, which was the big deal in the 70s. 20s, it was shareholder value. Then came Mike Jensen, and it became shareholder value as late as, you know, the Business Roundtable announced it in the 90s. They were very slow to announce it. I forecasted already then that they will get back to stakeholder value. But it's a message of what emphasis to put.
Can we just, I just want to, a couple of things. So as you say, if as long as pursuing non-shareholder measures explicitly results in higher value, which will play out for the shareholders, that's, as you say, that's a win-win, and that's easy for directors and managers to buy into, because they don't have to make any choice at all. There's no choice to be made between stakeholders and shareholders. It's the same objective. But I wonder if people who push back against that say, but it isn't always a win-win. Sometimes there are certain things, selling certain kinds of products, for example, that may be very beneficial for the profits of your firm, and therefore for your shareholders and for your employees, but which may have detrimental social effects. So maybe there are circumstances where you can't resolve these things in terms of a win-win. The other, just be interested in your comment on this. Leo Strine, I'm sure you know, was former Chief Justice of Delaware, and now has gone to work at a private law firm. And when he talks about Milton Friedman, as I understand, he says, when Milton Friedman was writing in 1970, it was a different regulatory environment. So his point is, you can rely on government regulation to force a firm to internalize its externalities if regulation is robust. And he said in the 1970s, it was better than it is now. But we've gone through a period of deregulation, and maybe we can't rely on that as much, so that maybe now the burden has to shift to directors and managers to kind of take it upon themselves to do what 40 years ago regulators would have done. Does that ring true to you, or do you think that that's not what you've seen?
Let me say two things. You sort of had two parts. It's the question about, can they sometimes do something that's wrong? Fiduciary duty, when it comes, for instance, to do they have to take the highest bid or something like that? That I think is that I don't want to go there, because you have a ton of lawyers listening and they understand this much better than I do, what Delaware law will actually say about it. In that sense, I think it's still in effect. And that's what, say, Oliver Hart and Luigi Signal is trying to actually change literally, so that wouldn't be required. But what I'm saying is that even in those bids, it presumably is going to reflect, all these values. The fact that somebody bids high on the company and wants to take it private, the evidence is pretty clear that I don't think they will suddenly become some evil people who, do something bad about ESG. Every company today, I would say, is attentive to ESG. So now to the second half of your question about, what if guns in Walgreens is what Oliver and Luigi all the time talk about. I think that I don't have an objection necessarily to their idea. They are, by the way, about shareholder wealth. They don't try to say they should go. They are about win-win in some sense, but they are win-win in a broader sense, in that the shareholders' values on issues that don't get directly reflected in share price or long-term value, those should be possible to communicate by some kind of vote. So this would be one example. I don't have anything against that itself. That I have questions about it, but I think in the context of maximizing shareholder wealth, I think that's also maximizing shareholder wealth. And I don't know what it is that I forgot who you referred to. That regulation, yes. So regulation, I think, is much more complicated today. I mean, it's we are talking about the globe. We are talking about climate change. We are talking about issues, gender equality, all sorts of things. I would say climate change is really tough. And one has to keep in mind that a lot of CEOs would like to know how to maximize. I mean, these are not things where a CEO knows exactly what to do. but they are certainly sensitive to this issue of what to portray it. I don't agree that they necessarily, just sort of window dress, and I think a lot of CEOs do it because they know it's good for the firm, and so I don't see anything having changed that much. But of course, if the Business Roundtable says this is especially valuable now, it's a way of communicating. What they feel is that there are risks involved and so on, and in that sense, it helps the CEO to understand it.
I want to circle back. You mentioned Oliver Hart and Luigi Zingali's paper, and I just want to, just for the benefit of people who may not have seen that, actually Oliver Hart visited Western a couple of years ago and gave that paper. And the paper, for people who haven't seen it, is a paper that says that corporations should maximize shareholder welfare, not shareholder value. And as Dr. Holm just said, the way they'd implement that would be to say that shareholders would get a vote on things. The example he gives is, he gives a few examples in the paper, but it's things like if a company is deciding whether or not to sell ammunition or something, like that, let the shareholders decide. And in commenting on their proposal, a lot of people who have commented on their proposal worry a little bit about the practicality of shareholder votes. But you've had another very interesting insight into that I would be interested in hearing you talk a little bit about, and that is, you've said one of the other challenges of having that shareholder vote is that it affects one of the real advantages of the corporation, which is anonymity. Can you talk a little bit about that?
Yeah, it's sort of, we'll come back to this probably because I want to build it up a little bit, but the short of it is that, limited liability and it makes it's anonymous. The fact that there's a board, there is of course a moment when we can express our views, which is the annual meeting and the shareholder meeting, but otherwise I don't need to know who owns the firm necessarily. I mean, it has changed a little bit because there are nowadays, you take Engine One case, or you look at all these sort of corporate traders or corporate, influential investors that think that a big change has to take place. I mean, but they are very visible. People see them, and Carl Icahn is going to, come in and wants to change it, and then I know that there is an influential person on the board. So via the board, you do of course see differences of opinion expressed. But if I would have to start thinking, that is this little thing, suddenly going to, it's politicizing it. Its anonymity is going to be destroyed, because I need to start thinking perhaps about more frequently about, is this something where they are suddenly going to go overboard with disinvesting from anything that has to do with negatively with climate change or something like that. I mean, you have to start thinking about those issues, and I don't want to exaggerate that, but I can see that I think it's going to politicize something that expressly it's going to destroy sort of, in that sense, the homogeneity of the simple prescription of maximizing shareholder value, and it could be used in various ways. So I worry about it. It's worth reiterating, why does Luigi and Oliver, what is their case for voting? Well, they say that they think it's more effective than just selling your share and take the vote, and it's a complicated model. It's actually a pretty complicated model, but in simplicity, the argument is that if you have small shareholders, it will be very inexpensive for a small shareholder to vote, say, for, yes, let's be more concerned about climate change, because the cost of doing it, whatever that is, 100 million or a billion or whatever it is, it's going to be split up with among all the small shareholders. And so that is, but their feelings for, say, climate that adds up. You see, in one case, it's sort of free riding. I'm voting for something that I know Chris is going to have to pay, and 10,000 others. So it's not a big deal for me. My share moves a little bit. But actually, 10,000 people may have a strong opinion on climate change, and that adds up. So they will vote for. The point is that the hurdle for voting yes is low, and doesn't take as much of a belief in climate change as it would otherwise. Now that said, so it's going to go through more easily. But for the same reason, something bad may go through equally easily. We are changing the system so that, there's a misalignment in that sense, so the direct votes will have much more power than with others. Now, if you think that it would be right that, maybe there comes people who vote that we should fill Walmart with weapons, or, whatever else, that supposedly if there's enough for people with that mindset, that will also go through more easily, even if you are just mildly in favor of that. So you have to understand that it's kind of symmetric, their argument. You get all sorts of things could go through.
Yeah, and you referred to this, you mentioned, so this is the Hirschman framework that we're all familiar with. You have two, you can exercise voice, or you can exercise your power through exit. And in a market system with a company that's publicly traded with a liquid market, it's very easy to exit if you don't like it. They're suggesting the time has come for people to where they oppose something the corporation is doing, instead of exiting, that they should exercise voice. That raises, it raises the anonymity issue. And the other thing that you've talked about, and that I think comes from Henry Hansman's work, again, I'm just thinking of reasons that we have economic activity carried on in firms rather than everything being done sort of in a disaggregated way, is the question of homogeneity of interest. You mentioned that already, and that's all. Would that be compromised? So the idea, Hansman's idea was, the reason we give shareholders the ultimate say is that they are the people who have the most common interest. They aren't conflicted in the way that other stakeholders are. Does a framework that would advocate for more shareholder activism, more people stepping up and saying, I don't like what my company's doing, does that undermine the sort of the Hansman idea of why we give shareholders the vote in a corporation?
I even perhaps thought, I'm a big admirer, by the way, of Hansman. I think Hansman's thing is really brilliant. There are criticism about it, and it's not flawless, and he's recently been celebrated. His book was celebrated. But what I like about it as a scientist is that he actually was interested in not-for-profit companies and cooperatives and other things. And he discovered an interesting fact that whenever you had these, in these other companies, they tended to be as narrowly focused as they could. And he read into it that the reason for that was that voice is expensive. Cooperative, is structured in terms of its governance in a way that, tries to minimize the cost of voice, the cost of voice and haggling and discussions. I mean, you see this in spades in family firms. I mean, family firms are the ultimate example of how costly voice can be, and how political issues can become if we take some other aspects into consideration. And so that was Hansman's view, and so his question was, why? Then he realized that this answers the question, the interesting question: why is it that investors are actually the ones with voice, so to speak, and this decision? And the naive answer is, well, of course they have to have a voice because they own the firm. Well, the question is, why are they the owners? And why aren't they? And the answer is that there are lots of other companies like cooperatives and partnerships and law firms, you name it, that are not, in that sense, investor-owned in the joint stock company perspective. So there's probably more of those, and there are, of course, other institutions. And his point was that the singular role and the success that the joint stock company has enjoyed over hundreds of years or at least over 100 years. That is best explained, according to Holmstrom, that they have a shared interest. And there's also, of course, limited liability. So, but the efficiency of that form, especially the public company, is coming from the fact that we all strive for the same, we have the same shared objective to maximum. And that, of course, so I wanted just to explain where Holmstrom's brilliant insight is, because I thought it was such a wonderful thing to be studying. You know, they don't he didn't study joint stock companies. He studied those companies that were not organized as joint, and that informed him about what's good about the joint stock company. I think it's just brilliant as a sort of intellectual exercise. You know, I can't say how much that changes, but it is that concern I'm having in some sense, is that, you know, it could change. And as I said, family firms, which, by the way, the Alstom that I talked about, the two, had my first 2 years was a family company. And it was working very well until actually it ran into a lot of trouble because the shareholders grew large in number, and there were a lot of fights and other things. And it's today far from being the biggest company among the biggest companies in Finland, because they liquidated a lot. So in the public company, you know, the fact that we can sell and buy shares, that's the exit option for individuals. And it's enormously valuable in that sense. Despite all the private equity and other things, you know, this ability to sell and buy. Private equity, by the way, is hitting today the same problem. Or you know, there's conflicts. You know, there's conflicts in partnerships. There's conflicts in rock bands. You know, they start with homogeneous objectives, and when they get successful, they can suddenly, you know, really dissolve and so on. So people, I think Holmstrom touched on an incredibly important, you know, explanation. And I can't say that the hard signals, you know, initiative will destroy this, but it's bringing in voice, you know, and voice is costly. But it has a structure that's simple. So I'm not saying, you know, it's still, they have a mechanism, or they don't have a mechanism actually, because we come into questions which things can be voted on, you know, when will we vote on, will it be binding? I mean, there's just a ton of practical problems. And imagine being a CEO that's subject to this kind of, you know, any day suddenly somebody comes and says you have to do X. The board can say something like that all the time. I mean, if you don't, the board can decide Walgreens doesn't sell.
Yeah, I mean, the Hardens Galley's paper, and I think Oliver Hart has said that about it. It's an attempt to square the circle a little bit. I think the way he introduced it when he came here, he said, you know, everyone who studies economics comes away with a healthy respect for markets. So you understand why it is that you can't just throw them out, but is there a way to interpret that in a fashion that would allow what seem to be behaviors that are, at least in the view of some people, not being regulated in a way that forces companies to internalize their externalities, that allow shareholders themselves to do that. And I wanted to come back, because I know you've written a lot about this, and I want to get your perspective on it. You have sort of canvassed the history of corporate governance, that we are now in an age, I think you've called it stakeholder plus age. I think that was the term you used. But we've gone through these cycles of the corporation being run just for the shareholders, corporation being run for a broader stakeholder group. And you've written a lot, both on your own with co-authors, about how we should think about that progress. So can we talk a little bit about what you see as sort of the development of, I guess, primarily US corporate governance, although it's had parallels in Europe and in Canada as well, starting with the 70s model of the corporation?
Yeah, I worked on, Steve Kaplan is one of them. I was influenced by Mike Jensen. I still think Mike Jensen's early work about, you know, he was the first to understand in some sense, among academics, in my view, the value of LBOs, for instance, and these were not or takeovers, hostile takeovers. Well, but LBOs especially, he had really interesting views. He made a mistake when he thought that everything will become an LBO. You know, the end of the corporation was a mistake. But you know, that's just one makes those mistakes. It was an exaggeration, and it got attention. But
well, he had a good idea, and he tried to universalize it.
He had a good, and it had influence. He of course pushed also very hard for these executive compensations. He has since, taken a turn in a different direction, in my view. Some think he's still the same Mike Jensen, but I think he sort of recanted and kind of disowned his own early views, which I think is a mistake. I think he was right on, as an academic. And influence the course. Now that's over. But if you look at those fluctuations, I think there is always an issue of, if you look at the 70s, this was an example where executives could do a lot of things. They could, buy, they could support race cars, or they could, whatever happened to be, or they could support sports teams, and they could sort of use corporate money for various, what they thought were goods. Perhaps they were useful for many people, but they were especially useful for themselves. They became, idealized in the communities and so on and so forth. And that's one of the downsides, perhaps, from they sort of didn't think enough about actually maximizing shareholder value was barely mentioned in annual reports, in those days.
And that's the context in which Friedman wrote his article, was exactly at that time.
That it became sort of, we are sort of guardians of bigger things and so on, and it was abused, in my view. I think he was right about that. But that's not at all the same stakeholder argument that, in my view, is surfacing now. But anyway, so then they went to shareholder value takeovers and so on, which were vilified by Main Street, and politicians eventually became the norm. And we have seen this shareholder value to extremes, in the sense of executive pay. I think went overboard to some extent, but it's hard to tell. I can't tell what is the right. I think the main problem was they were very badly designed in the 80s and 90s. I mean, I wrote about it with Steve Kaplan, and I think now they have, eventually the backlash came with the financial crisis and the Enron crisis and so on, and it changed things. So we are now back to stakeholder value, but as I said, stakeholder value plus, the plus here is that I don't think ever as big an issue as a existential role, that the corporations sort of have to think about the whole planet, so to speak, and think about these big social issues that typically is, something that the government is sort of, that externality is not natural for the corporations to deal with. Obviously, they will be critical for solving the problem, but somebody else should express the voice. And so that's why I said it's, it has an enormous impact on corporations already, in my view, and Paul Polman has been one of the drivers, and it has been the reason being that it has been win-win. This has been what you do in order to keep your value up, or at least please the institutional investors and so on. So as I said, the Friedman's main thesis is not changing. They have pretty much pursued win-win in my view, and even today. But the voices are stronger, and they are different. They are not just politicians that saying it. Is Greta Thunberg and her group of young people. I love it to see that it's the young people who are really pushing for this, because I think it's their future, and I think we should be very attentive. So I'm absolutely not against ESG. I think ESG is very important.
But you
But
have
maximizing shareholder value, in my view, should be that's going to drive it. Self-interest is going to drive it.
You've made the point in your work that these changes that we've seen, so the 1970s, as you said, the corporations were, the managers were pretty much in control. They weren't focused on shareholder value, at least not explicitly. You say it wasn't appearing in annual reports. They could indulge their own private, interests in charitable causes or whatever, and so on. And then something happened in the academic literature. We saw it through, you've heard of Michael Jensen and William Meckling's paper on agency costs, and then suddenly the shift was to shareholder value, and back. But the point you've made is we shouldn't think of this as evolution towards an optimal solution. That these events or these changes are responses to circumstances at the time, and
yes.
And so, can you what was it? So you've described in your work the 80s as the bust-up wave, all of those takeovers, usually financed by debt, by junk bonds, the leverage bond, the leverage buyout era. The 90s, I think you called the build-up wave. Still lots of acquisitions, but now primarily friendly. And a lot of them were exchanged, but they were paper bids. They were financed by securities, not by debt. What was it in the environment, legal, regulatory, whatever, that in your view can explain that shift from managerialism in the 70s through shareholder value in the 80s, the bust up to the what you call the build-up wave in the 90s?
Well, one thing is technological change. I think there was a need. There was a lot of money on the table, so to speak, for shareholders. So technological change was one of the drivers, and then the institutional money, was a driver. So if you think about Cozy world where we maximize the size of the pie, the technological changes clearly changed them. There was a need to increase the pie, opportunity to increase the pie, and the means of doing it was for the takeovers, which became available because of the institutional money growing so much. So the pie was split also very differently. As you know, workers got a lot less. That was, of course, also driven by globalization. And China's role and so on. So these are the forces that change the exit options, and with the exit options, change also how the pie got split. But also technological, the sunset industry, we know from looking at Europe that they were slow in responding to the need to change. So US has always been very dynamic when it comes to going after the new things. So the markets versus managers, who should make the decision? And when we are talking about moving money in short distances, as I call it, if it's about the industry that the manager or executive really knows about, the market shouldn't necessarily weigh in on that. Should you do model X or model Y? But buyers maybe, but not the shareholders. But when we talk about moving things from sunset industries onto entirely new industries, I think it has played itself out exactly that way. That then the market and the VCs and all these people are better than the old managers. If you look at Europe, what happened in Europe was that Nokia is a good example, in the sense that, it was in 30 different industries. It was, many of them were sunset industries, and they almost went bankrupt until Olila came. And then they just moved. They sold off things and moved, and sort of the top of the pyramid still stayed around. So Europe style is, the top triangle is still there, and they just move themselves to something entirely different. They much more rarely, they sell off things, but they sort of, they think it should be a move within the company or by the company's decisions. It should be a move, whereas US is saying, give me your money back. and we will take care of where we put it. Because why would you be the best? You were there in paper industry. Why should you decide where we should invest in some digital industry or something like that? So do you see, it's a very different Europe versus Europe doesn't have the capital markets, but they increasingly have. So that's what I was talking about as seeing the shift. There was a need to move, reallocate funds, and it was enormously successful. I mean, this market pressure was enormously successful in getting rid of the wrong kind of activities, and then eventually also start new activities with VC money and so on. And I think the US is that dynamic has played itself out. So this is just all part of the same argument that that the market maximizing this value is a good thing.
So globalization, deregulation, technology advancements all create the conditions for a need for companies to shift to, or the economy to shift into new kinds of businesses. It's very difficult for corporations to do that on their own. Some businesses do it, but that's hard. And you're saying that you see that more commonly in Europe. But it's much easier for the markets to do it just by it's impersonal, and it's fast, and it may seem harsh, but you're playing a kind of a bugs game if you try to prop up industries that are going to collapse anyway in 15 or 20 years. And then so those conditions prevailed in particular through sort of the 80s and 90s, and so that would suggest that, and I think you've said this actually, that if we don't see that rapid, those were the conditions that gave capital markets a comparative advantage with respect to interior firm shifting. If those conditions don't continue to accelerate at that rate, we should not expect to see that to continue. And would that be an explanation as to why we are swinging back, or seem to be swinging back, away from shareholder primacy to ESG, or are there other factors? I guess in particular the unusual consideration of climate change.
Well, as I said, in my thinking, this is a small shift for the business roundtable to say stakeholder value. It would be a bigger shift if something happened in the Delaware court, but I'm seeing it just part of the same. I try to say that these are not sort of in conflict. It's just about the emphasis. And by the way, the business roundtable typically follows very slowly behind, as opposed to lead. But now they were pretty, I would say they have been quicker this time around. But I would like to say, maybe if we shift it so that people don't think, I'm basically saying that corporate, or my view, let's put it that way, is that corporations don't need some dramatic, change in the shift. I really, those people who say, we should just tear this whole, whole organizational structure up, and the power relationships, and we should rebuild from scratch, somehow this joint stock company. That I disagree with that, obviously. And what I'm saying is that there is a lot of big shifts happening within this structure, and it has showed itself to be quite flexible over the years, but not perfect in any sense. But I don't think, I would like to see for a while whether we should. I don't see right now a big need to change. Public pressure is a very valuable input in this. That's a new thing on the table. I would like to see government be more involved also, and they are actually. You see how the central banks are getting involved with ESG, especially climate change. And the big thing that I think it's needed, say, for climate change, where the corporation can necessarily do as much, is that we need more information about what the effects are. We need a sort of, I sometimes put it as, we need a double bookkeeping on environmental pollution and damage. That is a parallel bookkeeping, so to speak. What do you do for it so that the shareholders can judge for themselves, and the customers can judge for themselves, and the Greta Thunbergs of the world can judge for themselves, and hammer at companies that don't respond to these activities. That's I see that as a healthy system playing itself out. I would like to see it, you know, unfortunately, the politicians seem very slow, but I think this corporate mechanism is relatively big. Maybe the argument somehow is that, you know, since the politicians are so hopeless in this certain people's view, we should just sort of re-engineer the corporations to do something else for the world. Well, I tell you, that's going to be, I mean, if that's what they are after, I think they should start, which they have already started, by creating companies that are socially conscious or some alternative form, but forcing everybody to change, you know, sort of scrapping the corporation and changing the rules of the game for the corporation in a dramatic way is I think that the attack against sales executive pay has been valuable. One of the best, if I may say a few words about what it feels like to be on the board, because one of the things that bothers me is that many who write about corporations and so on, you know, academics, I can't speak for the lawyers, but I can speak for the economists. You know, they have somehow, you know, from my experience, they have no idea what's happening on the board. The board is a communication and trust are just incredibly important. You know, if you don't sit there to monitor things and sort of ask them, you don't question everything they do. Cultures are different. So, you know, just like, you know, families can argue, you know, a lot and still be very close and so on. Some families never yell at each other and so on. I mean, it's same with the board. But on the whole, you have to be pretty civil, and you are allowed to ask questions. But questioning everything is a non-starter. Jensen was on, I think, several boards, and he lasted for exactly 2 years, he said. And that's what he said at the time. I don't know if that's true, but you know, yes, because you put a Jensen in there who, you know, all the time, you know, says you are not good. You have to change the CEO, you know, but you have to let the CEO drive the car. I mean, you don't drive from the you know, from the passenger seat. That's an old saying, you know, for which still applies, that CEOs, you know, there's nothing good comes of forcing on a critical issue, forcing a CEO to go left when you actually want, he wants to go right. I mean, then you have to just say, we are in disagreement and we are separate, you know, we go separate ways. Because there's got to be sort of mainly a mode where we are trying to sort of think hard about things and put on the table things that we are concerned about, but it's got to be, you know, the executives that are driving the car, and so in that sense, I have welcomed, you know, Gilson's and Jeff Gordon's, you know, board 3.0, but I think, and some of that is happening. That one of the interesting things, private equity is now taking sort of stakes in public companies, which is, you know, it's almost like exceptional. But,
yeah, let me just, I want to just to give a quick 2-second on the model you're talking about. So this is Ron Gilson and Jeff Gordon at Columbia. Board 3.0, their suggestion is that boards in the 20th century have gone through kind of a couple of different iterations. The first board was the advisory board, where directors were just there to kind of give strategic advice and nothing more. Then we went to the monitoring board. They would say that's where we are today. This is the Michael Jensen board, and I think from what you're suggesting, and you talk about Michael Jensen's own challenges in the boardroom itself, it starts from a proposition that it's the agency cost theory. It starts the proposition that managers are just looking out for themselves, and so the board's job is to be guardians, and that has built into it a kind of an attitude as to what the proper relationship is between boards and managers that I think you're saying is probably not a productive one. And their board 3.0 proposal was essentially that we should be taking a cue from the way in which private equity works, that you want directors who are highly resourced, well-informed, and I've forgotten the third thing, that they're highly incentivized, and that's what's missing in the board, the model today. So that's the model you're referring to, and again, so I'm sorry to interrupt you there, but just in case people hadn't read Gilson and Gordon's paper, what's your take on their model? Is it realistic, or is it does it have some shortcomings?
Yeah, I'm sympathetic to it, but again, I'm always against, typically I'm questioning, initially at least, whether one should do something dramatic. And as I said, private equity is already starting to do it. Some VCs are starting, hanging on to companies. So this sort of money, that we just are there for the money and for financial operations, that's sort of out the window these days. They want to be more operational. I mean, private equity always wanted, but they want to be more operational, and they go into public companies and make them more operational. So they have expanded sort of their role. So in a sense, we don't need a new. I don't know that Ron and Jeff really wanted something new in that sense either, but it's happening. There's a general point about capitalism. If there's money on the table somewhere, there's a lot of people who will find it, and they will come up with ways to sort of go. But they typically, in my view, sometimes they want to grab a bigger share of the pie. That's true. But they also want to maximize the pie where possible, so that they could get a bigger share. So, this basic belief in capitalism, when there are exit options, and coming back to the family firm, there are no exit options, and they self-destruct quite frequently. So, once they get very heterogeneous, Huntsman is right, trouble. So listing it, a family firm is, or exiting the whole thing in some ways, handing it over to somebody else is a very common answer to the problem. But there are unhappier endings in this case. So that's where I'm coming from. I guess I have reiterated many times, but yes, I'm not I could point this. I said that earlier to you, that there's a question of, why would private equity want to go? They want sort of very informed guys, and that are brilliant and smart, and then these guys want a stake in the company. They don't like the idea that I'm there as a small player and I'm doing something very good for all the shareholders, the small shareholders. They are not in that sense benevolent, most of them at least. I don't know what Carl Icahn is doing, by the way, now. He had only 200 shares in McDonald's, or which was, I don't know what happened to him, but that's an interesting thing to see. But Engine One, for instance, which has been promoted as, say, supporting, and I think maybe Oliver and Luigi had some influence, but that was undertaken within the rules of the current game, and was successful. They changed, the board structure, and Exxon has been under pressure also to do the same, and so on. So on the whole, I believe that in that sense that the system is playing itself out. So we can discuss about ESG and how important it is for corporations, and maybe how I think these measures, focusing on measures that are valuable for attending to this, especially climate change. I think it's a horribly difficult problem, but I tell you, markets, like pollution markets, and we need more, not less capitalism in that sense. We need, maybe water should be, water rights and other things, but also more broadly, water has to get a price. As soon as you have a price on things get a lot simpler typically, and I'm afraid that I want to remind people that I'm from Finland, and that I'm coming from a country that is let's call it very socialist in its sort of typical European socialist country, and successful in many ways. And I'm not I'm now speaking about this particular subject, but that doesn't mean I'm sort of some extreme right wing or something.
Oh,
like
well,
that.
in fact, again, anyone who'd read your work would know that your work is on this is quite nuanced. And as I say, as I read you, your work on governance talks about the fact that corporations do and properly should respond to social concerns, and that's exactly why they're so good at making incremental decisions, and that's sort of a absolutely in line with the notion that as people become more aware of these issues, and climate change is probably the most significant one because it's kind of this transformational issue that companies, of course, are going to have to respond. You mentioned Engine One. I mean, Engine One, is kind of very famous in this space because it was a very small fund, and yet it mounted a successful campaign against Exxon. Although, as many people have pointed out, it's a challenging story just from the point of view of ESG and so on, because of course that same fight could have been waged entirely on performance metrics, and you would have gotten the same result. I mean, it wasn't so that you didn't have a good control there for what would have happened if Exxon had not been having a lot of traditional financial performance challenges as well. I wanted to just, one of the things that you've talked about, and it kind of goes back to the proper relationship between directors and officers. And you've talked about the fact that they're not just monitors, and if they were, we'd have a different rule for who can sit on boards. But you've also said, and I'm sort of intrigued by this, and you mentioned it a little earlier, that something happened that I guess in the 90s as a lead up to all of the scandals, the Enron type scandals in 2000. What's the link? Like what was it that was going on that brought us to the point of all of those disasters? And I guess I know, and you've talked about more recent meltdowns like the Wells Fargo scandal.
Well, let me say, I mean, the Enron thing was a classic case, classic in many ways. 3 years in a row, it was voted the best company in the world or something like that, or at least in the US. And the 4th year, it was bankrupt. So, they were playing an old game about, that was self-serving, and I'm not privy to, information on how the board sort of missed it. But I think what happened was, they had these spin-outs and let these executives take stakes in them, which I think is a red flag always. But they were very successful. And, they did one of them, they did two. I'm sure they discussed the first one very carefully. They saw what happened, they did another one and so on. And eventually, I think they were up to hundreds, if not more, of these cases. And then when they start to come at that rate, you have had success after success, the board basically rubber stamps it because you cannot read everything. I mean, it's impossible. You got to sort of trust things. But when something new comes up, you tend to look at it carefully. And so that's when you can get build-ups of something exactly that something is very successful initially, but then something turns, some contingency or condition or wrong incentive comes about, and then it sort of collapses. And I think that was the story of Enron, and the Wells Fargo was similar. I mean, it always starts with success first, because if it isn't success first, it will die. So everything, all scandals are always first successful, and then I would say that in some sense, what's surprising is that there are so few of them, as opposed to the fact that they become such big news is a testimony to this system working relatively well. This doesn't mean that we should be complacent about it. Let me say one thing that I like about Sarbanes-Oxley, that really, as a board member, one of the sensitive issues have always been that the board did not say, when I was on the Nokia board, we wouldn't talk without the CEO there typically, because he was also a chairman, Jorma Ollila. I mean, by the way, Nokia went from bankrupt to one of the world's 10 most valuable companies in 8 years on traditional business, not, .com business. So it worked pretty damn well. for all the commentary about its fall. And it's doing pretty well right now too, again. Anyway, that's a side remark. The point is that there are situations and that should allow boards, non-executives to have discussions. And sometimes actually, the reason we didn't have it normally, of course, in private, within a few individuals, but we didn't have official meetings because the CEO knows that he can be kicked out any minute. A phone call of the board can throw a person out right now. There's absolutely no guarantee for a CEO. So if you have built up, like Olila had built up, 280 billion from 0 to 280 billion, you feel pretty committed to this. It's sort of your baby. And if you would be thrown out, if you have to get nervous about being thrown out for some minor, dip or something like that, you have a right to be concerned. It's like saying, to the lawyers or academics, you can't do economics anymore. You have to start all over. We are burning all your papers, or something like that. We have to have sympathy to the CEOs. They are, all of them, typically nervous about, or they have, this is back in their mind. So Jack Welch said famously, if the board ever meets without me, I'm out of here. And that was taken to be very arrogant. I understand totally what he was saying. That was some arrogance, yes, but he would be very nervous about what the hell are they talking about. So then Sarbanes-Oxley comes and says, you have to meet without the CEO. That was a brilliant move because it took the whole stigma of it out. And it is valuable to meet without the CEO, not because we are scheming things and it's just a different conversation. And so I experienced that on the Nokia board, and I think this is one of the best changes that was done in the Sarbanes-Oxley space in legislation.
But by mandating it at every meeting,
yeah,
the CEO can't think, well, you're not doing this because you have something that you have to talk about. You're doing this because you have to have the meeting.
Yeah, exactly.
At this point, if there's anyone watching who would like to raise a question, please do so. I guess we don't have the capacity to do it. You have to do it through the Q&A. But just while we're waiting for those questions, I see a couple coming in. I do also want to give you a chance because I know that you've talked and written a lot about the potential impact of digital platforms. You've called it a transformative business model, and I do want to give it a chance to hear your view on that. But let me I've got a couple of questions here that have come from people who are watching. Here's the first one. This was going in the context of, I guess, of ESG and of stakeholder capitalism. And the question is, when we're talking about a corporation serving its stakeholders, who exactly are the stakeholders? And the question goes on to say specifically, for example, is the environment a stakeholder?
Well, in the environmental case, we are all stakeholders. That's obvious, the society but it just points to one of the problems, that if we should maximize stakeholder value, whose value should we maximize? And it is an issue for the environment. I mean, we don't think of it that way now, but it could go overboard in principle, at least, this concern for the environment. I certainly think that we are very far from going overboard with the environment, but it can be pursued in the wrong ways also. Sometimes, one of the things is this greenwashing, that is it meaningful that Finland, moves a paper machine or whatever machine, to a less developed country where they will use the same machine and just it's going to pollute more, not less. We know how to sort of run it efficiently, and we can sort of take care of these problems. So that's one of the big problems right now, is that you are seeing countries sort of showing up that we are really good citizens of the world, and actually they are not, because they are no longer liable for the pollution that's caused at the other end. So that's why I would like to have double bookkeeping of pollutions, and a lot of and markets where those can be traded, the so-called offset markets, so I think markets will play a very critical role in solving this problem, but we need also measures and information.
I have another question. This is a question posed by my colleague Alan Miller, who is heads up our law and economics research group. It's a lengthy question, so here it is. He says there's a view that corporate law could be improved by lessening the accountability of managers to shareholders and by giving these managers a defense, for example, in the context of takeovers, that they're working in the interest of other stakeholders. There's some US legislation in a lot of states that does that. Before the pandemic, this view found its way into proposals to reform corporate law, such as Senator Elizabeth Warren's Accountable Capitalism Act, which if it had ever become legislation, would have required corporations of a certain size to all effectively be benefit corporations. The most well-known justification for this kind of thing is the team production theory. It's referring to a very famous paper by Margaret Blair and the late Lynn Stout, which itself draws from, or at least identifies the source of its arguments as, quote, moral hazard in teams. So that's the preface. Here's the question. Do you think there would be any benefit to come from weakening shareholder control over managers, or would that simply lead to more slack, more waste, or self-interested decision-making on the part of managers?
Well, that's a good question, because it is what I have, I have kept talking about, why the baton sort of should be handed to one person, or, the executive plus the CEO and the executives, and then also, of course, of the boards, as part of that group. And the reason being exactly that the moral hazard in teams problem is, so one solution is that somebody takes over it and the others are given exit rights, so to speak. That's sort of the capital. That's at the very core of capitalism, is this exit rights, that you have an option, you have alternatives. Even here, Friedman was, in my view, foresighted. And that was, he called it free to choose. He didn't say, let's have competition or something. Competition is a consequence of choice. You give people choice, opportunities for alternative choices, that will force the others to respond in a capitalistic system. Competition will ensue, and that's the powerful driver. And so in that sense, the moral hazard, I have actually a paper that is very little known, but articulates this view in the context of the Grossman-Hart model. The Grossman-Hart model essentially is a model about how do you solve or some of it can be interpreted as a model of what's so good about the market. It's built as a theory about, the firm. But actually, there are no firms; they are really just individuals. And the core of the theory, in some sense, is who should have the voice and the right to decide, and who should have the right, who can be taken care of by exit rights. So for me, this whole sort of team problem, the magic of the market is that we are, all of the United States, in some sense, engaged in a huge team problem, if you just want to think of us as contributing to GDP. But the measures that we get that allows us actually to sort of give everybody his or her share of this pie is these exit rights, that we can go to other places and we can build on from there. So I think that's the context in which I want to give the baton really to the CEO. I'm coming to his final, so I try to explain why I think the moral hazard in teams is actually quite relevant here. And the firms, in some sense, my view of the firm is it's a big internalizers of externalities. Think of shopping centers or something like that. Think about a street with shops that can do anything. They can play music loud and so on and so forth. And then you have a shopping center. Shopping center has a lot of rules. How long you can be open, how loud you can have your music. They are pricing these places differently. Apple probably is paid for coming into a shopping center and so on. So this is an example this is a good, useful example to think about. You know, firms are in the business of internalizing externalities, but they shouldn't be let out into areas where there are no externalities. Now that view, the CEO should be a guardian or an executor for this sort of charge of internalizing externalities. And of course, you know, I think they should be held accountable for it, and you know, having a sufficient stake in being paid, you know, based on the market value of the company, and or somewhat different, perhaps richer systems, but on the whole, you know, holding shares in the company is a useful way. The problem is that it's very expensive for the company to give. If you really want the shareholder to come back, CEO to have a significant stake, then it costs a lot of money for the big companies in particular. So we don't see it, you know, give 1%. I mean, we see big payments, but they are still, you know, and people get upset about them, but as a percentage of the company, they are small. And but no, I don't think we should give some free lease to these CEOs, but I think they should be held accountable through you know, the board and the you know, the consequences for their purse if they do you know, wrong things. So the turnover has increased, by the way, because of, I mean, one of the big challenges is that we get new technologies now, and they're going to be challenged by the new technologies, you know, a lot of companies, and then probably the CEOs will be changed.
Well, Bengt, we're coming to the end of our time, I'm afraid, and I really wanted to have a chance to also ask you. I know you've done a lot of work not only in the history of corporate governance, but I know you've done a lot of thinking about the future of organizations and governance. And we had planned to, and I wanted to talk to you about your thoughts on the importance of digital platforms that I know you've thought a lot about, but we have unfortunately reached the end of our time. We've already talked about this offline, but I'm hoping that when the pandemic is completely over, we can get you to come in person to Western. We can host you here, and we can pick up this conversation, and in particular deal more with some of your views on the future of business and the transformative effect of digitization. But in the meantime, I want to thank you so much again for speaking with us today as part of our annual Business and Law lecture series. It's been fascinating for me, and I've enjoyed the chats that we've had leading up to this as well. I've learned an awful lot. I've also learned how much I don't know, but that's has a value as well. So thank you again for joining us. And as I say again, I do hope that we can invite you back to Western so that you can see this room that I'm sitting virtually in. I'm not in this room at all, but that's our moot court room, that you can see this in person, and that we can have you here perhaps in the months or years to come. So thank you very much again.
Thank you for having me. And yes, I would be happy to come. And I must say that these Zoom events are this format I like best, because at least I see one person live, so to speak. But there is no substitute for seeing a whole audience and seeing what they think and having them interrupt me and disagree with me and so on. So unfortunately, you were very kind in your questions, but I would have liked to hear people perhaps wanting to take the discussion in some different direction. But yes, the big topic, I think, in the future is the new technologies and the new organizational forms that are coming.
And with that, we'll leave that to be continued, hopefully here. Thank you, everyone, again. Thank you, everyone, for joining us. And I wish everyone a great end of the week and a great weekend as well. Bye for now.
Thank you. Thanks, Chris. Bye-bye.
Bye now.